Welcome to The Explainer. Today, we're cracking open the specialist toolkit that financial experts use to manage and, well, survive truly catastrophic risk. We're talking about the kind of high-stakes events that can threaten to bring down entire companies. Okay, so here's how we're going to break this all down. First, we'll get a grip on the problem itself. Then we're going to dive into 3 key tools: a really smart way to share risk called surplus reinsurance, a method for trading financial obligations called swaps, and a way to measure the true cost of disaster, known as TVR. Then we'll see how it all comes together. All right, first things first. We need to understand the fundamental problem these pretty complex tools were actually designed to solve. It really is all about facing down massive financial uncertainty. This is the big question, right? I mean, when a massive hurricane hits, or an earthquake, or even a major financial crisis, the claims can be absolutely astronomical. A single event can unleash a tidal wave of losses that could easily sink a company that isn't prepared. So how on earth do they stay afloat? Well, the answer is they don't face that wave alone.
And that brings us perfectly to the first tool in our kit, reinsurance. It's really a foundational strategy for intelligently sharing the burden of these huge, unpredictable risks.
You know, the simplest way to think about reinsurance is just insurance for insurance companies. An insurer pays a premium to another company, the reinsurer, and in return, that reinsurer agrees to cover a piece of their losses. It's an absolutely critical way to move risk around and stop one single catastrophic event from wiping them out completely. But here's where it gets really clever. With what's called surplus reinsurance, it's not just about sharing every single risk down the middle. Instead, the insurance company sets what they call a retention limit. That's the amount of risk they're comfortable keeping on their own books, and they only pass on the surplus, the amount above that line, to the reinsurer. And this table just lays it all out, crystal clear. With a standard quota share, you give away a fixed percentage of everything, whether it's a big risk or a small one. But with surplus reinsurance, you get to be strategic. You can say, you know what? I'm confident I can keep most of this small, predictable policy on a local shop. But for a huge, volatile risk like a massive office tower, you wisely choose to only keep a small piece of that. It lets an insurer fine-tune their risk exposure in a really powerful way. All right, let's switch gears and move to our next tool. This one solves a totally different kind of problem. It's for those situations where you've got 2 parties with opposite, mismatched financial needs. Just picture this scenario. You've got Company A. They have a loan with a fixed interest rate, but they think rates are about to drop and they'd much rather have a variable or floating rate. At the same time, you've got Company B over here. They have a floating rate loan and they're terrified rates are about to skyrocket. They want the safety of a fixed rate. See the problem? Both of them are stuck with a risk they don't want. The solution is actually pretty elegant. It's called a financial swap. Instead of going through all the hassle and cost of refinancing their loans, they simply agree to swap their interest payment obligations. It's a powerful kind of contract that lets them trade cash flows to better manage their own individual risks. So, and this is the crucial part, the underlying loans don't actually move. Company A still officially owes its bank a fixed rate, and Company B still owes its bank a floating rate. But behind the scenes, they're paying each other's interest. So Company A gets the variable rate exposure it wanted, and Company B gets the fixed rate stability it needed. It's a win-win. Our final tool is a measurement technique, and it's designed to let us look right into the abyss. It helps us put a number on the scariest risks of all, those tail risks that are so extreme, they're hard to even imagine. And this is a massive challenge. These low probability but super high impact events, they're what keep risk managers up at night. How do you possibly quantify a 1 in 200-year storm or crash? A common place to start has been a metric called VAR. Value at risk, or VAR, tries to give an answer. A risk manager using VAR might say something like, okay, with 99% confidence, our portfolio will not lose more than $10 million tomorrow. It's a way to draw a line in the sand for expected losses under pretty normal conditions. But, and this is a huge but, here's the critical weakness. That statement is great for the 99% of days, but what about that other 1%? What happens on that one terrible day when you do lose more than 10 million? VAR tells you absolutely nothing about how bad that loss could actually be. Is it 11 million or is it 100 million? VAR is completely silent when disaster strikes. And that is exactly where tail value at risk, or TVR, comes in. TVR is designed specifically to measure the average loss inside that disastrous 1% tail. It answers the vital next question. Okay, we've crossed the line into a disaster scenario. What's the expected damage now? It gives you a much more realistic and frankly sober picture of what the worst case really looks like. Okay, so let's just step back for a second. We've looked at tools to share risk, trade risk, and measure risk. How does all this fit together to build a more stable financial world?
Well, they really do form an architecture of stability. Think about it. Companies are in a constant juggling act. They're balancing the need for profit, the pressure from competition, using their capital efficiently, and all the demands of regulation. These kinds of risk management tools are what allow them to navigate those trade-offs, to be both competitive and resilient at the same time.
So at the end of the day, these tools aren't just abstract financial jargon. They are the hidden engineering of our economy. By letting risk be shared, traded, and measured in an intelligent way, they help prevent catastrophic failures. And that ultimately helps protect all of us. And this leaves us with a really important forward-looking question. The world of risk isn't standing still. With new, complex threats emerging, things like climate change and massive cyber attacks, the toolkit for managing risk has to keep evolving too. The search for the next generation of these tools is already well underway.